There is a way to do this. Credible measures that deliver and anchor savings in the medium term will create space in the very short term for accommodating growth. In other words, we want to get out of the vicious circle that I was describing earlier on by entering into a virtuous path. And that goes through a slower pace of consolidation in the immediate short term, for some countries, not necessarily all, and a much downloaded program that in the medium and long term delivers the saving that will be needed to slow the debt, stabilize it, and then reduce it. Now, of course, the precise path is going to be different on a per country basis. Some have no choice but to cut deficit now, and they simply do not have the luxury of creating this path which begins low and finishes high. They just have to cut because they are under such market pressure that there is no option but to do that. Others should stick to their adjustment plans, and many advanced economies have put together those plans, so they have to stick to the plan, but they have to be very, very attentive to the pace of growth at the moment and be prepared to relax a little bit and certainly to let the economic stabilizers work. And some countries, not many, but some big ones, have the space to actually allow for those growth-conducive measures and space in the short run, provided, and that's critically important, provided that there is an anchored way of actually reducing those deficits and stabilizing the debt to reduce it in the long run. It is not, by the way, what kind of adjustment there is. It is also how this adjustment is being produced. And I think that both in relation to the short-term measures that would allow that growth space and in relation to the medium and long-term measures that anchor this more virtuous approach to public finances, the how is critically important. And certainly in our mind, it goes through entitlement reform. It goes through the kind of tax reforms that broadens the base, and that needs to happen in all advanced economies. It is happening in some. There are many countries, for instance, in Europe that have taken the decision to completely revise their pension system so that the entitlement is stabilized in the medium and long term. This is the kind of reform that we have in mind in terms of entitlement. Now, policymakers should also deal not just with sovereigns, they should also deal with households and balance sheets. Incidentally, in light of the job crisis in the United States, I certainly welcome President Obama's recent proposal to address growth and employment. But at the same time, it remains critical that this be associated with a parallel track that actually indicates and anchors those medium-term actions and decisions that are so needed to stabilize the debt and to redress for the better the debt trajectory. Equally, in this country in particular, it will certainly be important to consider relieving overburdened households through actions like more aggressive principal reduction programs or helping homeowners that take advantage or should be able to take advantage of lower interest rates. Now, turning to Europe, the sovereigns must address firmly their financing problems through credible fiscal consolidation. Goes without saying. And to support growth, with the risks that are lurking in the background, it is also critical, in my view, that banks be able to strengthen their capital by way of capital buffers, for instance, with a view to avoiding the deleveraging that is the other natural tendency to actually strengthen the institutions. That is, so much for repair, having looked at sovereign, households, banks, and always with a sort of balance sheet perspective. If we look now at the second R, reform. Reform is about the longer term. The repair was the fixed immediate action that need to be taken, followed by proper maintenance. It's not, it's one thing to repair, but you have to keep maintaining what the repair has produced. The reform is about much longer term, and it's about laying the foundations for a more stable economic future tomorrow. And in that particular section of reform, I see two critical areas that need attention. And the first one is the financial sector reform. There are some good news in that category. On the plus side, there have been, some will find long discussions about capital ratios, liquidity ratios, the stability of financial institutions. Well, I would just call your attention to the fact that although it has lasted a little over 2 years, it's been a lot faster than what had taken place in the previous discussions in Basel. Basel II took about 8 years. Basel III, which is the set of rules and regulations applying to the capital ratios, liquidity ratios, and overall supervisory environment of banks, that has taken a lot less in this Basel III phase, and it is good. But substantial gaps remain in areas like supervision, and particularly cross-border supervision in regard to international banking institutions. Cross-border resolution, which is still, to be tackled on a global basis and with proper national and regional ramifications when it comes to the legal system. The too important to fail issue, and the development of the shadow banking systems. The fact that in the last 3 years, some progress has been made, but not enough to actually be able to say in the face of the depositors, the people who put their saving in those institutions, we've done the job, I think is a question that needs to be addressed urgently. We also need in that regard to develop and fine-tune macroprudential tools to guard against financial risks. I'm thinking here of policies like having banks hold more capital in good times so that they do have those capital buffers, those counter-cyclical policies that will actually help them in the tough time, or implementing maximum loan-to-value ratios to guard against housing prices bubbles, for instance. Progress has been made, there's no doubt about it, but it needs to be reinforced and it needs to be leveled, because we need, institutions need, and more importantly, the general interest need that level playing field where there is as little regulatory arbitrage as possible. Now, under the reform banner, I would also include the social dimension. Employment must be central. It's at the core. If the economy grows, but if jobs are not created, it's not a waste, but it's a massive human waste. And it is especially important amongst the young people who risk, this lost generation syndrome that we should by all means try to avoid. The third R is rebalancing. Now, one might argue that, this is really a general principle and it's not an immediate concern. I would argue that it is a critical point. And what I mean by rebalancing is this dual rebalancing that needs to take place, where we move from public support to private investment. And that hasn't really yet taken place. The second rebalancing that is equally important is this rebalancing where the deficit economies operate differently and the surplus economies operate differently. And that goes through various measures because in some countries the rebalancing is just held back by excessively protective regulations or by the lack of appreciation of exchange rate. So that rebalancing is very important. Put it very simply, it's a question for those countries that have a massive deficit to actually be able to operate differently, to save more, and for those countries that have a massive surplus to actually consume a bit more domestically, and not just by way of investment or massive infrastructure projects, by domestic consumption. And to that end, clearly, letting appreciation happen when it comes to currency is very important. And this lack of rebalancing hurts everyone. In our interconnected world that I referred to, the thought that one country or a set of countries, because they're emerging, for instance, could be decoupled from the rest of the world is an illusion. Total illusion. In the advanced economy, if the advanced economies were to succumb to recession, the emerging market economies will not escape. When you're a big supplier of goods, you need clients around the planet. And it's as simple and as basic as that. So rebalancing is in the global interest, and it's also in the interest of each and every economy of each and every country. I think Woodrow Wilson would have appreciated that, Jane. That would be in his mantra. Now, my fourth and final R is rebuild. And here I'm mainly thinking of the low-income countries that need to rebuild their economic policy buffers, including their fiscal positions. They had such buffers for many of them, but they had to use them at the time of the financial crisis and in the last 3 years. There has to be some rebuilding so that they can protect themselves against future storms. And this will also help provide the space for growth-enhancing public investment and social safety nets. For example, allowing countries to deploy well-targeted subsidies to protect the poor from commodity price swings with minimal damage to fiscal sustainability. Now, having gone through my 4 R's, I can't resist mentioning a fifth one, and I did say that was my last one, but I will indulge if you allow me. And that is the role of the IMF. What's the IMF in it? What's the role of the IMF in all this? Well, it is a critical role. It's a critical role because, number one, we can help countries with appropriate national, regional, and global surveillance. I've been a Minister of Finance. I've been a Minister of Trade. There are things that you simply don't see for yourself because you're right in the middle of it and you're trying to row this boat, but you don't necessarily have the distance and the impartiality to actually analyze exactly the strengths and the weaknesses of your economy. So that work of surveying how things work, how they interconnect, what is the spillover effects of some of the decisions that are made in one country and that will affect the others, with the degree of impartiality and academic skills and talent that is required and that I was very lucky to find when I joined the fund. That's number one. Number two, we have the ability to provide the level of technical assistance that will actually help countries, and I'm thinking, for instance, of the country in the Middle East and North Africa, to build their public finance sectors, to build a proper fiscal system, to develop their tax system, to organize the collection of tax, to build their monetary institutions. We can do that. In many corners of the world we do. And certainly those countries will continue to be the recipient of technical assistance support. And finally, the third arm of the fund is our lending capacity and ability to actually respond to moments of crisis, to current account imbalances, and to situations where there is nobody else but the fund that can actually come to support by way of lending, not by way of subsidies, not just dumping money without consideration, but under programs that are well established with appropriate conditionalities. And let me say, because everybody has a pitch, I have my pitch, and I'd like to share it with you. Let me say that the International Monetary Fund is actually critical for the world, but it's also critical for the United States of America. I know in hard times there is a tendency to trim around the edges and to think, oh, well, that's not really critical. Mission critical is something else. 3 points. First of all, the International Monetary Fund is a disciplined, organized, I hope well managed, but that will have to be demonstrated, and I will do my best for that institution. It was one of the Bretton Woods institutions, and when I was asked whether I would be intimidated as a lawyer by background to operate with economists, essentially, 2,500 of them, more or less, I was a little bit. Until I came to the fund, and I realized how disciplined, organized, rule-based it is, and how the principles actually matter over the arbitrary decisions and the discretion of doing as we please. It's an institution where my main shareholder is the United States of America, with 17% of the quota rights, and de facto a veto right on all the key decisions. That's reason number one. Number two, because I've heard that, why should we invest our money? Might be a waste. Well, any dollar, any euro that is invested in the fund goes back to the member. 187 members